The S&P 500 has delivered exceptional returns over recent years, climbing to record levels throughout much of 2025. Yet beneath this bullish surface, a growing chorus of analysts, institutional investors, and market observers are raising alarm bells about valuations, structural vulnerabilities, and the sustainability of this rally, prompting serious questions about whether a significant correction or even a crash might be looming on the horizon for investors who have grown accustomed to seemingly endless gains. Understanding why investors are losing faith requires examining multiple interconnected factors ranging from stretched valuations and artificial intelligence spending concerns to persistent inflation, geopolitical tensions, and Federal Reserve policy uncertainty, all of which collectively paint a picture of markets that have perhaps priced in perfection while ignoring mounting risks that could materialize suddenly and violently. Goldman Sachs recently estimated a 30% probability of major stock market corrections in 2025, while veteran investor Jeremy Grantham, known for his prescient calls on previous bubbles, warned of a potential cataclysmic decline that could see stocks fall as much as 50%, reflecting the polarized and increasingly nervous sentiment among professional investors who manage billions in client assets and whose reputations depend on navigating treacherous market conditions successfully. At the heart of investor anxiety lies the issue of valuation, with the S&P 500 trading at price-to-earnings ratios exceeding 24 times forward earnings in many calculations, significantly above both 5-year and 10-year historical averages that typically provide context for whether stocks are cheap or expensive relative to their profit-generating capacity. Other metrics, including the Shiller cyclically adjusted price-to-earnings ratio, price-to-sales multiples, price-to-book values, and the Buffett indicator, which compares total market capitalization to gross domestic product, all suggest that American equities are historically expensive by nearly every measure that financial professionals use to assess market valuations. The forward price-to-earnings ratio reached approximately 30 in certain measurements during 2025, a level that historically has preceded market turbulence and corrections, raising uncomfortable comparisons to the dot-com bubble of the late 1990s, when similar valuation extremes preceded a devastating crash that wiped out trillions in wealth and left countless investors nursing severe portfolio losses that took years to recover from if they ever did. What makes these elevated valuations particularly concerning is that they rest heavily on expectations of continued robust earnings growth and stable economic conditions, meaning that any disappointment in corporate profits or deterioration in macroeconomic fundamentals could trigger rapid repricing of assets downward as investors collectively rush for the exits in a panic that feeds on itself and accelerates the decline. Investment professionals point out that when markets trade at premium valuations, the margin for error becomes extremely thin, and even modest, negative surprises can produce outsized reactions as the gap between optimistic expectations embedded in current prices and disappointing reality becomes suddenly apparent to market participants who had previously been willing to suspend disbelief and pay high prices for stocks. The concentration of market gains within a narrow group of technology giants has become another focal point of investor concern and debate, with the so-called Magnificent Seven companies including Nvidia, Microsoft, Alphabet, Amazon, Meta, Tesla, and Apple now representing approximately 30% of the entire S&P 500 market capitalization, a level of concentration that strikes many observers as dangerous and unsustainable over the medium to longer term. This extraordinary concentration has been driven primarily by enthusiasm around artificial intelligence applications and the belief that these particular companies are uniquely positioned to capture the economic value that AI will supposedly generate across industries and sectors in coming years as the technology matures and finds practical applications. The problem with such concentration is that it creates significant vulnerability because the broader market's performance has become dependent on a handful of stocks, meaning that if sentiment shifts regarding AI profitability, or if these companies experience disappointing results for any reason, the entire index could suffer disproportionately as the narrow pillars supporting the market crumble. Consider what this means in practical terms for ordinary investors whose retirement accounts and savings are invested in index funds tracking the S&P 500. They are unknowingly making massive, concentrated bets on a small number of technology companies, rather than enjoying the diversification that indexing is supposed to provide. And this concentration risk could produce painful losses if these stocks stumble. The artificial intelligence investment boom has been extraordinary by any historical measure, with AI-related spending accounting for roughly 2/3 of United States gross domestic product growth during the first half of 2025, as companies pour trillions of dollars collectively into data centers, specialized chips, cloud infrastructure, and all the physical and digital systems necessary to develop and deploy AI systems that they hope will transform their businesses and create competitive advantages. However, critics point out that this level of investment creates immense pressure to generate corresponding revenues and profits within a limited time frame, because shareholders and creditors will eventually demand returns on these massive capital expenditures. And when basic financial arithmetic is applied to assess how much revenue would be necessary to justify trillions in capital expenditure across the industry, the figures required exceed the total revenues of even the largest technology companies today, raising fundamental questions about whether adequate return on investment can ever be achieved. Some AI-focused stocks trade at forward price-to-earnings ratios between 50 and 70, valuation levels reminiscent of the dot-com bubble when investors paid astronomical prices for companies with minimal revenues and negative earnings on the theory that traditional valuation metrics no longer mattered in the new internet economy, a theory that proved catastrophically wrong when reality reasserted itself. Companies with minimal actual AI revenue have seen massive valuation premiums simply for mentioning artificial intelligence in their earnings calls or investor presentations, suggesting that speculation and momentum rather than rigorous fundamental analysis may be driving prices to levels that cannot be sustained once investors begin demanding proof of profitability rather than accepting promises and projections. The concern among skeptics is not necessarily that artificial intelligence lacks transformative potential, because clearly the technology represents a significant advancement with genuine applications across numerous industries, but rather that the timeline for monetization and magnitude of eventual profits may have been wildly overestimated by enthusiasts, and that current valuations have priced in optimistic scenarios that leave no room for disappointment or delay in the conversion of technological capability into actual corporate earnings. The Federal Reserve's monetary policy stance represents another critical source of uncertainty affecting investor confidence, as market participants attempt to navigate an environment where interest rates remain elevated compared to the ultra-low rates of the previous decade that fueled asset price appreciation across stocks, bonds, real estate, and virtually every investable asset class. Throughout 2024 and into 2025, market expectations for aggressive rate cuts were repeatedly scaled back as economic data showed surprising resilience, and inflation remained sticky, particularly in services sectors where wage pressures continue to exert upward pressure on prices as workers demand compensation increases to keep pace with their rising cost of living. Market participants currently price in approximately 38 basis points of rate cuts for what remains of 2025, equivalent to roughly 1.5 quarter-point reductions, reflecting deep uncertainty about whether the Fed will cut rates once or twice before year-end. As stronger-than-expected economic data, persistent above-target inflation readings, and concerns about potential inflationary impacts from Trump administration policies, including tariffs, have all tempered expectations for monetary easing. When the Federal Reserve raises interest rates or maintains them at restrictive levels for extended periods, this directly impacts stock valuations through multiple channels, including higher borrowing costs for corporations that reduce profitability, higher borrowing costs for consumers that dampen spending and economic growth, reduced present value of future corporate earnings when discounted at higher rates, and increased attractiveness of fixed income alternatives to equities as bonds and savings accounts offer meaningful yields that compete with stocks for investor capital. The relationship between Fed policy and market performance became painfully clear during 2022, when the central bank's aggressive tightening campaign aimed at combating inflation triggered significant declines across equity markets, cryptocurrency markets, and risk assets generally, with the S&P 500 falling more than 25% from peak to trough as investors repriced assets to reflect the new higher rate environment. While stocks recovered strongly in 2023 and 2024 as inflation moderated and investors anticipated rate cuts, the memory of that volatility lingers in the minds of market participants who recognize that any pivot toward tighter policy or extended period of higher rates could trigger similar sell-offs or worse. Longer-term Treasury yields have exhibited considerable volatility throughout 2025, with the benchmark 10-year Treasury note spiking above 4.5% during periods of tariff-related uncertainty and concerns about fiscal sustainability before moderating somewhat, reflecting ongoing debates among investors about inflation persistence, the trajectory of government borrowing and spending, and the appropriate neutral rate of interest that neither stimulates nor restricts economic activity. If inflation remains elevated despite Fed efforts and forces the central bank to maintain higher rates for longer than markets currently anticipate, or even worse, requires the Fed to resume rate increases after having cut them, this would likely pressure equity valuations significantly, particularly for high multiple growth stocks whose valuations are most sensitive to changes in discount rates because their earnings are concentrated far in the future. Individual investors who have only experienced the low-rate environment of the 2010s may not fully appreciate how different market dynamics become when interest rates normalize to historically typical levels, and the adjustment process could prove traumatic for portfolios built on assumptions of perpetually low rates and easy monetary conditions. Geopolitical risks have intensified substantially throughout 2025, adding another layer of uncertainty that weighs heavily on investor sentiment and creates potential catalysts for sudden market disruption that could catch participants off guard and trigger cascading sell-offs as automated trading systems and panicked investors rush to reduce risk exposure simultaneously. The erratic and unpredictable nature of United States trade policy, particularly unexpected tariff announcements targeting major trading partners including Canada, China, and Mexico, has repeatedly blindsided markets and disrupted the orderly functioning of cross-border financial flows that underpin global commerce and investment. Events like so-called Liberation Day, when sweeping tariff measures were announced with little advance notice, triggered sharp sell-offs in Treasury markets and pushed the 10-year yield to 4.592%, the highest level since February, as investors questioned the sustainability of American fiscal policy and the potential for trade wars to tip the global economy into recession. These trade tensions are not merely political theater or negotiating tactics that can be safely ignored, but have real economic consequences, including disrupted supply chains that increase costs and create shortages, higher prices for businesses and consumers that act as a tax on economic activity, and reduced clarity for corporate planning and capital allocation decisions as executives struggle to forecast demand and optimize operations amid constantly shifting policy landscapes. Beyond trade policy, ongoing military conflicts, including the Russia-Ukraine war, which has now entered its fourth year, and the Israel-Hamas conflict, which threatens to expand into broader regional confrontation, continue to generate instability while impacting global energy and food security, with higher commodity prices contributing to inflationary pressures that complicate central bank efforts to normalize monetary policy and return to pre-pandemic conditions. JP Morgan CEO Jamie Dimon, whose bank is America's largest, and whose views carry significant weight in financial markets, recently expressed serious concerns about stock market vulnerability in public comments, citing geopolitical tensions, global remilitarization as nations increase defense spending, elevated government spending levels that raise questions about fiscal sustainability, and high stock valuations as factors that collectively could contribute to a steep decline in equity values that catches investors unprepared. The Asia-Pacific region faces its own tensions, with heightened confrontations expected in the South China Sea, where territorial disputes and military posturing create constant risk of miscalculation or deliberate escalation, though analysts suggest that military escalation around Taiwan or the Korean Peninsula appears somewhat less likely in the near term, given the catastrophic consequences that would result from direct great power conflict. These geopolitical dynamics create an environment where sudden shocks can trigger rapid risk-off moves in financial markets as investors flee to safety, a scenario that becomes particularly problematic when asset valuations already reflect optimistic assumptions and leave little cushion for unexpected negative developments that force reassessment of risk-reward trade-offs. The fragmentation of the global economy into competing blocks with divergent regulatory frameworks, incompatible technology standards, and increasingly separate trade relationships adds long-term structural challenges that could weigh on corporate profitability and economic growth for years or decades, representing a fundamental shift away from the globalization that characterized the late 20th and early 21st centuries and supported corporate profit expansion. Beneath the surface of strong corporate earnings reports that have generally exceeded analyst expectations lurks a potentially dangerous buildup of corporate debt that could amplify economic downturns and threaten financial stability if economic conditions deteriorate and revenues fall while debt service obligations remain fixed. Research from academic economists and central bank analysts indicates that corporate debt accumulation, not just household debt which receives more media attention, can significantly worsen recessions and prolong recovery periods, particularly in emerging market economies where non-financial corporate borrowers dependent on foreign credit, denominated in dollars or euros, face acute vulnerability to sudden stops in capital flows and currency depreciation that makes dollar debts more expensive to service. Federal Reserve stress testing scenarios and financial stability assessments reveal that while debt servicing capacity appears generally robust under baseline economic conditions with modest growth and stable interest rates, a severe recession scenario would bring public firms' debt servicing capacity to concerning levels that raise questions about default risk and financial system stability, especially among riskier firms whose aggregate interest coverage ratio measuring earnings relative to interest expense could drop below the lows reached during both the Great Financial Crisis of 2008-2009 and the COVID-19 recession of 2020. In severely adverse scenarios modeled by Fed economists using plausible but pessimistic assumptions about growth, unemployment, and financial conditions, the percentage of corporate debt classified as at risk of default increases sharply and dramatically, potentially reaching almost 40% of total corporate debt outstanding, a level substantially higher than at any point since the Great Recession, including during the pandemic-induced downturn that required unprecedented government intervention. Persistently higher interest rates compared to the ultra-low rate environment of recent years pose particular challenges for vulnerable firms with weaker balance sheets, lower profit margins, and more cyclical business models, as the ongoing cost of servicing existing floating-rate debt rises while refinancing maturing debt becomes substantially more expensive when companies must roll over bonds issued at 2 or 3%, with new bonds carrying 6 or 7% coupons. This dynamic creates risk of cascading defaults and bankruptcies that could spread through credit markets and trigger broader financial stress that spills over into equity markets, money markets, and the real economy as credit conditions tighten and firms cut investment and employment. The nonlinear relationship between debt levels and recession severity documented by researchers means that beyond certain threshold levels, higher debt-to-GDP ratios significantly and disproportionately exacerbate economic downturns, with fiscal space constraints becoming binding when public debt exceeds approximately 58% of GDP and governments lose the fiscal flexibility to implement aggressive stimulus programs. Consumer debt also remains elevated across many measures, with high inflation eroding purchasing power, while elevated interest rates make existing variable rate debt more expensive and new borrowing prohibitively costly for many households, particularly among lower-income consumers and those with poor credit scores who lack access to favorable lending terms. These vulnerable households are cutting discretionary spending, adopting more cautious financial behaviors, increasing savings, and delaying major purchases, contributing to what analysts describe as a two-speed or K-shaped economy, where disparities between affluent consumers who benefit from asset price appreciation and own homes and struggling consumers who rent and live paycheck to paycheck continue to widen. This bifurcation in economic experience creates risks because aggregate statistics showing healthy consumer spending and low unemployment rates may mask underlying weakness among significant portions of the population whose financial distress is hidden in averages. And if stress among vulnerable households and corporations intensifies and reaches critical mass, it could trigger broader economic weakness through reduced consumption, falling revenues, corporate layoffs, and a self-reinforcing negative spiral that impacts corporate earnings and justifies substantially lower stock valuations. The challenge and paradox for investors is that while current earnings remain strong and the long-predicted recession has been repeatedly delayed, with each quarter bringing new forecasts pushing the expected downturn further into the future, the longer debt burdens accumulate both at corporate and household levels, and the longer interest rates remain at current elevated levels. Relative to recent historical norms, the greater becomes the underlying vulnerability to an eventual economic downturn that, when it finally arrives, could be deeper, more prolonged, and more resistant to policy intervention than typical post-war recessions that were relatively mild and short-lived. Market concentration beyond just the technology sector creates additional vulnerability that receives less attention but matters significantly for portfolio outcomes. And as passive investing through index funds has created structural dynamics where capital flows into the largest companies regardless of valuation or business fundamentals, simply because those companies represent the largest index weights. This mechanical buying pressure from trillions of dollars in index funds that must mirror benchmark composition has arguably distorted price discovery and created situations where mega-cap stocks trade at premiums that may not reflect underlying business quality or growth prospects, but rather reflect technical factors related to index inclusion and passive fund flows. When this dynamic reverses, either because active managers begin outperforming as valuations matter again, or because retail investors panic and redeem their index fund holdings during market stress, the selling pressure could be concentrated in exactly those mega-cap names that have led the market higher, amplifying declines in the overall index. Consider also that retail investor sentiment, while difficult to measure precisely, appears increasingly frothy based on indicators like margin debt, options trading volumes, particularly in short-dated call options, and survey data showing extreme optimism, all of which historically have been contrary indicators that preceded market declines when excessive bullishness left no marginal buyers to push prices higher. The democratization of trading through zero-commission platforms and gamification of investing through apps designed to encourage frequent trading has brought millions of inexperienced investors into markets, many of whom have only experienced rising prices and may lack the psychological preparation or financial resources to withstand a significant drawdown without panicking and selling at the worst possible time. Stories circulate of individuals taking out loans, maxing out credit cards, or investing emergency funds in stocks based on social media tips and influencer recommendations, behaviors that suggest dangerous speculation rather than prudent investing, and create a constituency of vulnerable investors who will be forced to sell regardless of price if personal financial stress or margin calls require liquidation. The options market shows unusual activity, with trading volumes in short-dated contracts reaching levels that suggest widespread speculation on very short-term price movements rather than longer-term investment based on business fundamentals. And this speculative activity creates additional volatility and potential for sharp dislocations when sentiment shifts. Corporate insiders, the executives and directors with the deepest knowledge of business prospects, have been selling stock at elevated rates throughout 2025, with insider sales outpacing insider purchases by substantial ratios that some analysts interpret as a warning sign that those most knowledgeable about company trajectories are taking advantage of high prices to reduce personal exposure and diversify wealth. While insider selling does not always predict declines, since executives may sell for personal financial planning reasons unrelated to business outlook, the magnitude and breadth of recent selling across numerous companies and sectors suggests at minimum that insiders do not view current prices as bargains and may harbor concerns about sustainability, valuations, or future business conditions. The historical pattern of bull markets and their eventual endings provides context that long-term investors should consider when assessing current conditions and risk-reward trade-offs for capital allocation decisions. Market cycles have been a consistent feature of capitalism for centuries, with periods of rising prices and optimism eventually giving way to corrections or bear markets that reset valuations and create new opportunities for patient investors willing to deploy capital when others are fearful. The current bull market, if measured from the March 2020 lows during the pandemic panic, represents one of the strongest and longest rallies in market history, with the S&P 500 more than doubling from those lows to current levels, a pace of appreciation that significantly exceeds historical averages for sustainable long-term returns. Some analysts argue that much of this appreciation simply represents recovery from the pandemic sell-off and multiple expansion due to monetary stimulus rather than fundamental improvement in corporate earning power, suggesting that normalized valuations would be substantially lower than current levels. The duration and magnitude of the rally has conditioned many investors, particularly younger investors who entered markets in the last decade, to expect consistent positive returns and quick recoveries from any sell-off, an experience that may prove misleading if the next downturn proves more severe or prolonged than recent corrections that resolved within weeks or months. Psychologists who study investor behavior note that recency bias, the tendency to overweight recent experience in forming expectations about the future, creates dangerous complacency after extended periods of rising markets as investors extrapolate recent trends indefinitely into the future without considering the cyclical nature of markets and economies. The question facing investors today is not whether another downturn will eventually occur, because that is certain over a sufficiently long time horizon, but rather whether current valuations and conditions suggest elevated risk that the next downturn is approaching, and whether portfolio positioning should be adjusted to reflect that risk through increased diversification, higher cash positions, defensive sector tilts, or hedging strategies. For investors dependent on their portfolios to fund retirement or other financial goals in the near term, a 30% decline from current levels, which several prominent analysts have suggested as plausible, would represent catastrophic losses that could require dramatic lifestyle adjustments or delayed retirement, making risk management crucial rather than optional. Even for younger investors with longer time horizons who can theoretically ride out volatility, the psychological and financial stress of watching portfolio values decline sharply can trigger panic selling that converts temporary paper losses into permanent realized losses, making it essential to maintain portfolio allocations that match risk tolerance and avoiding leverage or concentration that amplifies stress during downturns.